what should you be doing with your portfolio to ensure that you minimize tax consequences, especially since we don't really know whether we'll fall off that fiscal cliff come January. Liz Klayman is with the money manager in Cleveland, whose main focus is to ease that potential tax pain.
You know what, Lori, when you think about growing your money, you think about what toys you might want to buy. Well, how about a boat like the Nautica Queen? This is Captain Jim Dale. We've come aboard the Nautica trolls up and down the Cuyahoga River, but how do you Teflon coat your money when it comes to tough economic times and you want to make sure you have enough for retirement? Well, let's meet one of the top money managers, the wealth managers in Cleveland. He is Mark Tepper of Strategic Wealth Partners. Good to see you.
Good to see you, Liz.
How'd I look in the hat, right?
You look good. You look good.
Thank you. You know, we don't know what's going to happen with the fiscal cliff.
Right.
So there's a big question mark. But don't you, in a way, think that people should protect their money no matter what would be on the horizon? And how do they do that?
Absolutely. I think when you're looking to manage your money, you don't really want to look so much at what's going to happen over the course of the next month or two. You really want to have more of a 5-year time horizon. That's what we do for our clients. So one of the things we're seeing is that really in an environment where we're looking at some really growth over the course of the next several years due to our fiscal situation, focus on good, strong companies that are paying solid dividends above the average on the stock market.
Do you think about minimizing tax consequences?
Absolutely. Yeah, I mean, in a lot of the non-qualified portfolios that we manage, there is a pretty high MLP concentration. We do use MLPs from time to time.
That's master limited partnerships, usually oil and gas concerns.
Right. So Kinder Morgan's one of the ones that we like to use, and actually it pays roughly about a 6% dividend, and it's a very tax-efficient dividend because a good percentage of that dividend is considered a return of basis.
So Kinder Morgan is one of the stocks that you like right now. You also like Vodafone?
Right.
Why Vodafone? And not say Verizon?
Right, and actually it's good that you mentioned Verizon because Vodafone owns 45% of Verizon Wireless.
Right.
And the nice thing about Vodafone is it's more undervalued than Verizon, and it also pays a higher dividend yield than Verizon, so it's a great way to play Verizon Wireless without all of the wireline issues that comes with buying Verizon. So it's really a no-brainer at that point.
And again, when you're looking at putting names into a portfolio, can you really ignore technology? Is there a name that you like right now? Because tech has been a strong performer.
Right, yeah, we like Seagate. Seagate's actually up about 200% year over year.
I know, see, that makes me a little nervous because I think, am I buying at the height here?
Right. And believe it or not, it is still a really an unloved stock. The PE ratio is under 5 right now. It's got a dividend yield that's higher than 4. So we look at it as being really one of the best deals that are out there. You know, that for some reason investors don't like the stock because they feel that since we're moving towards cloud computing, that hard disk drives are just going to disappear off the face of the earth, and that's not going to happen overnight. You're
saying that's still around? Because people are worried about the PC market. They're very concerned.
Absolutely. It's going to stick around for some years to come, and there's such a huge margin of safety involved in buying that stock. How can you not do it when it's paying a 4% dividend yield at a PE ratio of less than 5?
I'll tell our viewers something about Mark. Mark focuses a lot on specific clients like entrepreneurs and doctors. Of course, the Cleveland Clinic is here. 3,000 doctors, 11,000 nurses. My dad was a surgeon. Notoriously bad doctors are at investing. My dad did okay, but, you know, he was Kodak. Kids, buy Kodak. We all know what happened to Kodak. But, you know, helping individuals like that, is there some type of customization you do for people? And can they almost take what you do and apply it to their own portfolio?
Yeah, I mean, for the entrepreneurs specifically that we work with, we're typically working with entrepreneurs approaching that exit point of their businesses. You know, they're within maybe 3 years of exiting.
Translation, selling and making a lot of money.
Right, exactly. So they're going to receive a substantial liquidity event, and the most important thing for the entrepreneurs at that point is really just making sure that work remains optional. So we don't need to hit a home run, we just need to get on base, we need to avoid strikeouts. So that's why specifically we're sticking with the larger, safer companies that are paying the dividends.
Okay, and finally, we got the jobs number today. Of course, unemployment goes down to 7.8%. See job creation. It's not as robust as people would like to see, but as a wealth manager, how closely do you look at data, or do you pick a point well far away from the horizon and say, let's focus on growing and protecting our money?
Well, I mean, it's really this big vicious cycle. You know, we need to see economic growth. In order for us to make a meaningful dent in that unemployment number, we need to see economic growth north of 3% a year. We're looking at GDP growth of about 1.3% right now, and that's not going to be enough for us to really start adding jobs. You know, when you're adding 125,000 jobs a month, all that's really going to do is help to keep up with population growth. So we need to see 250,000 jobs a month to reduce the unemployment rate by 1% a year.
Right.
It's going to be a tough path.
Still making his clients nonetheless. Mark Tepper, Cleveland's own Strategic Wealth Partners. Thank you for joining us.